As we approach the end of the first quarter of 2019, how has the year started for AIM stocks? Well, AIM portfolio manager Chris Boxall joins us now from Fundamental Asset Management. Chris, it's good to talk to you again. It's the first time we've caught up with you this year. Hello.
Absolutely, yeah.
How has the year started for you?
Well, it started pretty well. We had a good January. We saw a strong rebound, a lot of our positions. February was a bit slower, a bit mixed, and March again a little bit mixed. We're in the midst of reporting season, so there are large number of announcements, trading updates, annual results. Some companies very good, getting them out very quickly, and we're going to mention one of those, I think. Others a bit slow off the mark. Yeah.
Well, let's bring up your list of portfolio stocks you put together for us almost 3 years ago, I think it is now. You came up with a list, and this list has ebbed and flowed. We've seen some drop out. We've seen some come in. Bottom right-hand corner, we'll talk about Cortex and Digital in just a minute. One that is not there, for obvious reasons, is Patisserie Holdings. We spoke about this. You came in specifically to talk about Patisserie Holdings with a ticker CAKE. It failed. What went on exactly there?
A massive fraud. Could we have known about it? No, I don't think anybody knew about this fraud. The extent to it is now, well, greater than anybody could have imagined. Totally ridiculous. I think will shareholders get anything? At the moment, highly unlikely. The next move is what action will be taken, who will be held to account, and I think that's really important. And we've tried to encourage, through various means, action behind the scenes, notably through the administrators, or that's even more complicated than we anticipated. But really, and if anything does come of it, it's going to take years. There has been a case recently with Accor, another AIM-quoted company, and they successfully sued the auditors, Grant Thornton, and there was a ruling. I think it took 5 years for there to be a substantial payout, but it took 5 years, and the lawyers were the winners, quite frankly. But yeah, we'd like to see people held to account, and we'd like to know what happens. The key thing for shareholders, could we have seen this coming? No. What are the lessons? Hard to know what the lessons are, really. A cake and coffee shop going under, of all the businesses, no one could have predicted that. However, perhaps, let's be really objective, perhaps the one thing that it's highlighted is there is no protective moat to a cafe and cake shop business. You and I could set one up, and unfortunately, when it does go wrong, there is actually little value in it. And that's what we've seen here. With Patisserie Holdings, there was no value. What value was, in the acquisition from the administration? Nothing. I think it was sold for circa £5 million. Yeah.
Another one that doesn't appear on the list, I won't go back to the list, I do want to bring up a share price of, is XL Media. And if we can bring up the share price here, you can see you sold out of this. Why? What went on there?
We sold out of it before the quarter, before the trading update on our own client portfolios, and we regret not selling out of it before. It is a digital performance marketing business that's had a very bizarre period on the stock market. It raised money, a large sum of money, in order to support acquisitions. It has made a few acquisitions, and ironically, from the money raised, it's been buying back its own shares at much lower levels. It's totally absurd. Why we don't like it, and why we're concerned, is really integrity, credibility, and the opaque nature of their accounting. They've been reluctant to tell us, well, they don't tell anybody, the names of the huge number of websites they own, which are used to direct traffic principally to gambling sites, 2,000 plus websites. Now, there comes a point, post Patisserie Holdings, post other accounting issues, where we feel that people have to be direct, forthcoming, and very open in their accounting. And this business has failed miserably in this regard. And it came to the point that we felt we had to get out. They've announced today as well, broadly in line with what they were talking about. But again, there's a whacking great $55 million line related to the acquisition of domains and websites, for which no information is provided. You can't. I mean, it represents over 30% of their net assets. there's got to be more information provided. You can't be on public markets and be as opaque as this. It's just not great. So we had enough and sold.
Yeah. Let's take a look at the two new stocks on the block for us here. First one is Dot Digital, which, as you can see, that's 23.4% year to date. What is Dot Digital, and why have you been so attracted to it?
It's a lovely little business that we've held on the majority of our AIM portfolios for some time. We were regular purchasers, and we thought we'd introduce it to this one. We think it's a digital marketing company. It was well known for its product called Dot Mailer, so an emailing platform onto which it is bolting lots of additional features. And it's a business that terrific margins, 20% operating margins, great cash flow, great return on equity. Founders still have a significant stake. So from its relatively humble beginnings in the UK, it's grown a lot, and now it's expanding overseas. It's really, after an initially testing start in the US, it's really got going there. US business growing very, very fast, still very small compared to the rest of it, but we think it has a very simple offering. You know, it's got lots of customers paying it circa £900 a month. So loads of customers, great customer spread, and it just ticks a lot of boxes, and offers a nice little growing dividend as well, net cash, and a nice play, and we think it's a worthy addition to the portfolio. Good.
Okay, Cortex Holdings, briefly.
Cortex Holdings is a telematics business, again UK based, and it provides telematics devices. It started off providing for insurance-based clients. So the insurers were specifying. And from those beginnings, it's grown to offer its service to businesses that run small fleets of vehicles. And again, growing very fast in the UK, 30% plus. It's started an operation in the US and in France as well, and most recently, which are also growing very, very fast, and it's more recently set up something in Poland and Spain, all off the same platform. So it's got this underpinnings of a database from which it's now offering translated websites and services across Europe. And its products are self-install. So they provide the hardware to a small business that installs it in its vehicles. And it's particularly popular apparently in the US amongst landscape gardeners. So lots of them run small fleets, and there's a growing appetite for it. But very similar to Dot Digital, great margins, 20% plus operating margins, great cash flow. It's got surplus cash, so it's shoving that out as a nice dividend as well. What we like about this as well is the founder is still CEO, got about a 38% stake, and management remuneration very much aligned with other shareholders. So senior managers pay themselves a modest amount. They get a big dividend because they're big holders, and the yield's 4% and a bit. I think it really is a great example for small companies.
You've always been on to us about looking for companies that have ownership amongst the shareholders of the founders and the chief executives, and this is exactly what we've got here.
It's absolutely critical. In smaller companies, you should be investing in businesses where the founders are aligned. And what we like about Cortex as well is that they don't overpay themselves. So many companies come on the stock market, and all of a sudden the director's remuneration is 3 or 4 times it was when they were private for doing the same job. And probably perhaps less of a job. So they're taking money from new shareholders, many of whom can't care less, and paying themselves. I mean, it's totally bizarre.
But not for Cortex. Very briefly, I want to go back to the share price chart. Are you not at all worried about the fact we've been at, around about £4, and all of a sudden we got this emptying out in the last 6 months of last year, here being out to 57?
I'm a long-term holder. The play in this stock, its insurance business is declining. However, its long-term appeal is getting greater because it's all about its fleet business. Much like Dot Digital, lots of small customers paying regular amounts to it, and they control the customer base. It's become a marketing play. Nice software bolted into its own hardware, and now it's all about marketing. Great stuff.
Okay, let's move on and take a look at what you say is a buying opportunity. Fulcrum Utility Services.
Yeah, Fulcrum has had a terrible last few months, and it's a stock that whose share price has suffered really on the back of an acquisition it made, a business called Dunamis. Fulcrum provides utility services, gas connections, electric connections, and that's the original business, and it's increasingly owning its own gas pipelines. So it's a small housing development, for example, it would supply the gas pipelines into that housing development, and it would take ownership of the pipeline and have a regular recurring revenue through that asset ownership. It bought this business called Dunamis, which is involved in bigger, chunkier power installations, and Dunamis's activities have been, well, hit a little bit, delayed, predominantly because of Brexit-related reasons. Not only that, I think the management didn't help themselves by a large option exercise and subsequent sale of shares around just after they purchased Dunamis. So they went to the city, raised a load of money, then a load of the senior managers flogged out at a quite a high level. It doesn't help your credibility very much. So sentiment has affected this stock, but I think at its heart, it's a decent business with decent long-term potential, with good cash flow. And cash flow is very, very attractive. They get a lot of money in advance, specifically for the gas install business. So I think it could be an interesting buying opportunity. You get a nice dividend, sit there, wait patiently. You could see this thing re-rate and up it goes again.
Well, look, Chris, it's a pleasure. Thanks indeed for dropping by again.
Pleasure.
Tell us a little bit more about some of the stocks on the move in the world of AIM investment. That's Chris Boxall from Fundamental Asset Management.